So our scenario for the US economy is that really right now the US economy is growing pretty well. We have a model based on the Chicago Fed National Activity Indicator, which tells us that in year-on-year terms, based on that data, the US economy is growing a bit over 2%. And indeed, if we look at other parts of the Federal Reserve System, there is we used to use a Nowcast by the Atlanta Fed. It didn't show itself was so accurate last quarter, so we moved to looking at the New York Fed Nowcast. New York Fed Nowcast is published every week, every Friday, with an update, and the most recent update for the current quarter, is to say the second quarter that we're still in the US, is that the US economy is growing by an annualised rate of 2.34%, so better than 2%. So that's entirely consistent with our view that the US economy is growing pretty strongly now, and that's consistent with our model. But what we expect to happen is we expect the US economy to slow in the second half of the year. And there's a whole bunch of reasons, apart from tariffs, why that's anticipated. And so it's particularly interesting to look at the estimates that were put out by the Federal Reserve yesterday, and their economic projections of the Federal Reserve and the Federal Reserve presidents for the month of June. So what they show is that indeed the US economy is slowing down as we go into the second half of the year, and they anticipate that in 2025 GDP will slow to 1.4%, and that's lower than their estimate in March of 1.7%. Now that they think is going to be the low for by a slight margin in comparison to next year and the year after, because the year after they expect growth to accelerate to 1.6%, and the year after that 1.8%, and they think the long-term run is about 1.8%. I think it's probably a bit higher than that. I think it's about 2. I think the trend growth rate will be pushed up by a lot of the reduction in regulation that is happening under the second Trump administration, and also for because of the very aggressive write-offs, amazing write-offs, which are being included in the One Big Beautiful Bill, in which under those write-offs, if a company wants to build a factory in the US, it'll be able to write off 100% of not just the equipment in the first year, it will be able to write off 100% of the building, expense of the building in the first year. Now that would take, a lot of that would take decades to write off in Australia. So I think that's going to generate a stronger level of systemic growth, but let's wait for that to happen. Unemployment, they see unemployment rising to 4.5% as the economy slows down. Now, I think that's interesting because unemployment in the US economy right now is 4.2%. And in that circumstance, and they see inflation, the PCE inflation of 3% in our quarterly. We've got, but normally the CPI inflation, which we show in the quarterly, is 50 basis points higher than the PCE. So that's consistent with a 3.5% inflation this year in the US, and that's about 1.6% of that is because of tariffs. But they see that inflation level falling next year to 2.4% and 2.1% the year after. And that, anyway, creates a circumstance where they feel that they can cut the Fed funds rate. The Fed funds rate in the US is currently, if you look at I make it as 435 basis. What the Fed publishes, the New York Fed publishes, the effective Fed funds rate in the market is 433 basis points. But the Fed thinks that they can cut that by 50 basis points by the end of the year, end of this year. And that's really interesting because that's entirely consistent with the model of the Fed funds rate that I have on page 65 of the quarterly, which says that the equilibrium level for the Fed funds rate should be 385 basis points, so near as damn the same as their estimate of 3.9. And they see that, so that's a 50 basis point rate cut in the second half of the year. They see another rate cut, 25 basis points next year, another year after. And so that's very consistent with our own scenario of a US economy slowing down, rate cuts in the second half of the year and in the years after that. And that allows the US dollar to fall. And as the US dollar to falls over the second half of this year and through coming years, that lower US dollar generates upward pressure for commodity prices, and that generates a better outlook for Australian stocks. Going through the press conference that was after the statement, what Powell was talking about, he was talking about certainty and uncertainty, and what he was precisely talking about in this, and he had to remind a couple of the journalists in the room that was what he was talking about. He was talking about in terms of the certainty and uncertainty of the inflationary effect of tariffs. And he said that at the beginning of the year when the tariff policy was announced, it was very uncertain what the inflationary results would be. But as we're moving forward, it's becoming evident that those inflationary effects are limited. So he said we'd actually had 3 months of favourable readings on inflation, slightly better than was thought. And he said the real issue was getting to precise estimates of the amount and the size of the tariff effects as they came through. He was questioned on this by a guy called Howard Schneider of Reuters. He said, and Howard Schneider said, well, how can you say that risks have diminished? I mean, we've got countries in the Middle East firing rockets at each other. And he said, well, I wasn't talking about risks. I was talking about the data, the variability in the data, and that's the uncertainty of the variability of the price effects of data that has diminished. And so we're getting the Fed is getting a better line on what in fact the inflation effects of tariffs are. And I think they now believe that they're less than they anticipated at the beginning, which is why they can now decide to cut rates or look at cutting rates in the future. So he said that the tariff uncertainty peaked. Jay Powell said the tariff uncertainty peaked in April as to what they were looking for. And what they expected now was in the second half of the year was, open quotes, a slow and continual cooling in the US economy. So in short, our scenario of a slowing economy in the second half of the year seems to be consistent with what Jay Powell has been talking about yesterday. And therefore that allows rate cuts in the US in the second half, and that allows for the US dollar to fall. And that's consistent with our scenario of that in turn generating rising commodity prices.